Welcome back to Startup Essentials, brought to you by Carta. In this episode, we're going to talk about this new thing called the Corporate Transparency Act, which, if you're a small business in the United States, probably just popped onto your radar and made you go, wait, what? Under the new Corporate Transparency Act, most small businesses operating in the US are now required to report some new information to the government, and the details can be a little confusing. So over the next few minutes, we're going to break down everything you need to know: what the Corporate Transparency Act is, who needs to comply with it, what stuff you need to send and who to send it to, and perhaps most importantly for you, when you got to do all this stuff by. But before we get started, if you find this kind of startup information helpful and want to see more of it, do feel free to stay compliant with the like button. Subscribe, hit the little bell for notifications. It's helpful for us here at Carta to know what kind of information is useful to you so that we can continue making more of it. And with that said, let's get into it. This is everything you need to know about the Corporate Transparency Act. So right away, let's put it in super simple terms. If you're a small business operating in the United States, then unless you qualify for some kind of rare exception, you now have to report some new stuff about your business to the federal government so that they have the visibility they need to make sure you're not doing illegal stuff like laundering money or financing terrorism, etc. Which is basically the gist of the Corporate Transparency Act at a high level, but what is it specifically? Well, in order to understand that, it helps to start in the shadows and take a look at financial criminals. In general, people and companies that commit financial crimes tend to use all kinds of shell companies and weird, complex corporate structures to mask and distort the illegal stuff they're doing, like committing fraud, evading sanctions, financing things like drugs and terrorism, and so on. So as a part of this big defense spending bill in 2021, an initiative called the Corporate Transparency Act became an official law. The law's purpose is essentially just to deter financial crimes and prevent people from financing illegal enterprises like terrorism. Now, what that looks like practically for you is private businesses all over the country, just like yours, now have to report certain information to this government division called FinCEN, or the Financial Crimes Enforcement Network. So as a business owner, this basically brings up three main questions, right? Which are, what do I got to report? How do I report it? And when do I got to report it by? And surprise, surprise, as with all these kinds of things, it can get a little dense and lingo-y, which is why we definitely recommend talking to your lawyer. But let's make it as easy as we can for now and go through each one of these questions one by one, starting with the first question: what exactly do you need to report under the Corporate Transparency Act? In essence, the rules require companies to report info about their beneficial owners. And I know beneficial owner might be a new vocab word, so let's quickly take a look at a definition. A beneficial owner is essentially a person who benefits from owning something, like a company or property, even if their name might not be directly on the ownership documents for that thing. The government outlines this as follows. A beneficial owner is a person who either owns or controls at least 25% of any firm through equity, stock, or voting rights, or there's someone who, quote unquote, exercises substantial control over a company and its operations, which is a little vague, right? Like, substantial control could mean anything. So how do we define whether or not someone exercises substantial control over a company? Luckily, FinCEN, that government organization we were talking about, has some regulations that make this definition a little bit more specific. In summary, an individual exercises substantial control over a company if they meet any of these four criteria. 1, if they are a senior officer in the company, like a president, CEO, CFO, general counsel, etc., or if they have any other role with similar executive powers to that stuff. 2, an individual exercises substantial control if they have the power to appoint or replace senior officers or a majority of the company's directors. From there, it gets a little bit more, let's say, broad. Number 3, an individual exercises substantial control if they're a, quote, important decision maker at the company. And finally, number 4, this is my favorite one, an individual exercises substantial control over a company if they, quote, exercise another form of substantial control. That last one is obviously very deliberately a catch-all kind of provision, but it's that way on purpose. It's essentially intended to just acknowledge the possibility of unique or newly devised forms of control over a company. So, okay, we know what the Corporate Transparency Act is, and we also know that reporting companies have to supply information about their beneficial owners. But the question still stands, okay, what specific information about my beneficial owners do I have to report? So let's talk about that. In essence, under the CTA, FinCEN requires you to disclose information on 3 levels. Level 1 is the company level. Level 2 is the company applicant level, and level 3 is the beneficial ownership level, which we just talked about. So to make it easy, let's start with number 1, the company level. Real simple, reporting companies just have to provide the following basic identification information about themselves. The company name, any trade names, like if your company uses a public nickname or something like that, current US address, the jurisdiction where the company was formed, and 2 identification numbers, the IRS taxpayer ID, aka the TIN, and the employer ID, aka the EIN. So that's the company level, super simple, just got to report that little list of stuff. So let's now move down a peg to level 2, the company applicant level. At this level, if the company was created or registered to do business in the US on or after New Year's, January 1st, 2024, the company has to report who their company applicants are. So what does that mean? Well, it means at most 2 individuals need to be reported as company applicants. 1, the person who directly filed the company creation docs with a Secretary of State or similar office. And 2, if there's more than 1 person involved in that filing, then we also got to list the other person who is quote unquote responsible for directing or controlling that filing. And that's it. Level 1, you just got to report the company info. And level 2, you got to report who the company applicants are. So let's now jump down to the final level, those beneficial owners that we just talked about. At this level, reporting companies have to supply a short list of information about each person that is a beneficial owner. This list includes their full legal name, address, date of birth, plus a unique identifying number from an official document. This could be like a US passport, US state driver's license, foreign passport, or any other document issued by a state or local jurisdiction. And then finally, you got to report the actual jurisdiction that issued that identifying number. So to recap the whole thing, we got 3 levels of reporting: company info, applicant info, and beneficial owner info. You report those 3 things and voila, you are compliant with the Corporate Transparency Act. Beautiful. So I know I have to file some stuff, and now the question becomes, when do I have to file it by? The answer is super simple. Essentially, it all just depends on when your company was officially formed. So let's lay out a timeline here. Essentially, we're looking at 2 important dates: New Year's Day 2024 and New Year's Day 2025. And if we draw lines right down the screen at these 2 points, you can see we're basically looking at 3 main buckets of time: companies that were formed before 2024, companies that were formed in 2024, and companies that were formed after 2024. For the first bucket, this is companies that were formed before January 1, 2024. Your deadline to file your information is New Year's Day, January 1st, 2025. If you're in this middle bucket right here, it gets a little bit stricter. You have to file within the first 90 days of incorporating your company. And after January 1st, 2025, that's going to be the strictest window. You're going to have to file all of your information within 30 days of incorporating the company. Now, of course, as with all rules, there are exceptions. Specifically, when it comes to the Corporate Transparency Act, there are 23 different types of companies that are exempt from these reporting obligations. But fair warning, if you're hoping your company is on that list, it is very likely not. Most of the 23 exempt entities are types of companies that already fall under another type of disclosure regime, like public companies, banks, registered investment companies, and what have you. So, as far as startups are concerned, most early stage startups will not qualify for one of these exemptions and will have to start complying with the Corporate Transparency Act very, very soon. The penalties for not complying can actually be kind of scary. They include civil penalties of $500 a day, all the way up to $10,000, and even criminal penalties of up to $10,000 and 2 years imprisonment, depending on the severity of the violation and the company's history of compliance. And of course, these non-compliance penalties are made public. So in addition to the stuff we just mentioned, non-compliance with the Corporate Transparency Act could also cause your company to suffer some reputational damage as well. Which is all just to say, okay, I get it. I know what to file and when to file it. Now you just need to tell me how to file it. And this is where, obviously, I work for Carta, so how could I not mention that if you do have a free account on Carta to manage your cap table and equity, you can fill out all the required information right inside the app, and then just click a button and authorize Carta to submit the filing to FinCEN right on your behalf. We do our best to make it as easy and painless as possible. But If not, that's okay. You can still just go directly to FinCEN's website at fincen.gov and do your filing manually. And of course, our policy team here at Carta continues to engage with policymakers and regulators in Congress to help clear up some of the aspects of Corporate Transparency Act compliance that are still unresolved. So if you're not already reading our Policy Weekly newsletter, we got a link right downstairs in the description. Feel free to sign up and follow along. And that's it. Everything you need to know about the Corporate Transparency Act. If you found this video useful and you want to keep seeing more startup education content like it, we do encourage you to like and subscribe, hit the little bell for notifications, and we'll see you next lesson on Startup Essentials by Carta.